we're closer to some type of downturn than a 5 or 10-year bull market resumption from here, you know.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Okay, everybody, welcome to another episode of Talking Trades with me, Kevin Wadsworth, and my friend and colleague there, Patrick Karim. Okay, what we're talking about today, we're going to talk about the macro outlook for the economy. It's a big subject, but of course it is very, very important for the cycles in not just gold and silver, but stock markets and everything else. So knowing where we are in the economic cycle and how things are playing out at the moment and having a roadmap for where we expect that to go is critically important. So, Pat, let's take a look at the macro outlook.
All right, guys. And I'm going to do this in three steps, and I'll do it a little different way than maybe you're used to. I'm going to use some actual plays, some copper plays, oil plays, and then I'll situate you those, how they're performing in regards to the yields, how some of the macro, how the bonds player are pricing that in. So what I will do is I will share my screen right away. Okay, guys. So let's just start. Here I have a copper play, a Southern Copper, and not much happening here right now. It's going sideways, consolidating. That's fine. There's no issue here, but there's no breakout either. Keep that in the back of your mind. Here I have Freeport, another huge copper play. Remember Dr. Copper? Well, it hasn't broken out yet. It's still going sideways. Can we have a breakout? Possibly, but we need to get some evidence to wait until that breaks out to the upside. So I have two copper plays. They haven't quite broken out yet. Now Ivanhoe. Ivanhoe is another copper play, which is actually starting to move downwards. It's a more dire situation than we are with the two above I just mentioned. Lost a rising trend line on support right now. So it's still in a more precarious situation than its peers. All right, guys. Now let's look at the energy plays, right? And you'll see how this ties into the business cycle. It's very important. Here's Shell. Shell has a pretty good chart. Even on the higher time frames, I did the Shell chart, and you could overlay the yields chart on that, and it looks almost the same, right? We had low, explosion, then consolidation. It hasn't broken out yet, but there is a pattern here where it's looking that it wants to break out, but you have to wait for the actual breakout to be able to confirm anything, any evidence from a breakout for the Shell oil. See, here's the momentum distance from that 36-month moving average, so it hasn't broken out yet. Here's Exxon, another behemoth in the oil space. That could probably be a false breakdown, but right now it's going sideways. It still hasn't broken out. 119, 119.50, a solid close above that. Beautiful breakout. And look at these patterns. You'll have to notice these patterns. They come over and over again. They go in. We have the deep here in the 2020 lows, then move back upward. So it's a pretty bullish looking pattern, but you still have to wait for the pattern to break out. All right. Here, guys, I have Shell, Ivanhoe, Freeport, and Southern Copper all overlaid one on top of the other. And this is my step number 2. I want to show you how this interacts with the yields. The yields, I could have overlaid with that. To a large extent, these companies, while they have one's in the oil play, one's a copper play, they have different managements, all that stuff. But you'll see that they track the yields, that less risk of inflation or maybe less recessions. They track that. So if it's going sideways or down the yields, it's putting headwinds on these companies. And once after that, they go upwards. Look, they just love it there. They just, and the yields, they're in this triangle right now, very close to deciding whether that breaks out up to the upside or downside, or do we have a recession first, it breaks to the downside and then rockets upward? Because long term, this is still a bullish pattern, but it hasn't broken out yet. So, but you could still have a false breakdown to the upside to accommodate for a recession type of scenario. And then after that, once they start the money printing, long-term inflation expectations, all that stuff goes back up and continues upwards. So why is this all important, guys? This is the most important chart. It's my step 3 chart. And I'll break it down just for you a little bit more. Here, what I have The green overlay is the recessions. The black line is the tens. So this is a 10-year yields. The blue line is a 2-year yields. And what I did is usually we do a 10 minus 2 to show the yield curve on inverting. What I did on this chart is I synced them up. I synced them on the same percentage scales. And you'll see that when the jaws, when the 2-year, the 2s and the 10s fall, but the 2s fall faster. So you have that shorter term recession, that market risk, right? It's really the 2s, the shorter term, the Fed are starting to cut the rates, all that stuff. It's dragging that lower, and it's even impacting to some extent the longer term yields, creating some pressure downwards. That's when you got a recession. Here's a 1990 recession. Here, I didn't have the 2s here, but here was the 1981, 82 recessions. Here is the 2002 recessions. You see how the 2s, they just vomit while the 10s also go down to a lesser extent. Here's the 2008 one. Here is the 2021. You'll notice here, I didn't overlay the price chart for the markets, but the markets love when there's compression here, when it's tight, when the 10s and the 2s are close together. The markets, they just go crazy. This is like the 94, 95, all the way to 2000. That was one of the greatest bull runs ever for the stock market. And see how the 10s and the 2s, they behave. They're coiled and tight. But as soon as they started detaching, that was it. As the 2s go back up and try to reconnect with the 10s, that's a recovery mode. Everything goes nice here. Here, power mode for the stock market. Before imploding in 2008, guess what? They separate again. And like here's a recovery. 2011, that's when gold topped. And that's when the markets really exploded, broke out from their 2001, 2007 highs, and then reconnect. And then we had a power mode here, but then after that, it just fell apart. Again, same thing again. I'm repeating, then back up. The 2s reconnect to the 10s, power mode. The stock market has been doing great. But look here, the gap is starting to widen. The 2s are not above the 10s anymore. They're below. So that's step one. If ever there's an acceleration of the 2s downwards and the 10s also going downwards, but the 2s going down faster, it's increasing the risk of a recession. And that means if the business cycle is starting to take a downturn, there's always a market, SPX, the drawdown. But then what's going to be the importance of that drawdown? We'll have to wait and see. Will it cascade into a 2001 bear market, a 2008 type of bear market, or will it be something lighter? You just have to wait and see. But the setup is 100% there for a market downturn, a business cycle downturn. Here are the 2s. The 2s are starting to fail. Lower highs, lower highs, lower lows. It's a big topping pattern. They're not breaking out to the upside. We've got a lot of headwinds here for the 2s. So the market is still not pricing in a strong recovery. They're pricing in rate cuts. Here are the 10s. The 10s are still not breaking out. The 10s are actually starting to fall apart here. Until the 10s break out back to the upside, this is not looking super good for the 10s and the 2s. So that's a setup, guys. The bond makers, the bond market is telling us that the 10s and the 2s are not pricing in some crazy thing to the upside. They're actually telling you that there's a risk to the downsides. If ever the 2s catch back up to the 10s, Kevin, I'm going to say, okay, fine, power mode. We're going to keep, of course, looking at the individual charts of the SPX. And those oil plays, those copper plays, if ever they turn to the upside, fine. That means recession risks are alleviated for now. But I just can't shake that feeling there that we're closer to some type of downturn than a 5 or 10-year bull market resumption from here, you know.
Interesting stuff, Pat. It's going to be fascinating to see how this pans out because, of course, the 10-year yield had an upside breakout from a 40-year downtrending pattern a few years ago. So I would probably see this as a recessionary breakdown if it happens, set within a bigger picture upwards trend. I mean, we saw that in the 1970s where we had breakdowns, recessions leading up into the peak in 1980. So the yields rose dramatically, in fact, during the 1970s. So within that big picture uptrend, there were smaller periods where you've got these breakdowns, which I think is what you're describing there. So let's see how it plays out. So if you like that content, you want more, and we can dive much deeper into this sort of thing, of course, hit the like, subscribe, and notification bell for much more. And we'll see you again for more Talking Trades. Bye-bye.